The announcement landed in Ottawa with the subtlety of a seismic event, a carefully worded press release that sent immediate shockwaves through diplomatic corridors from Washington to Tokyo. It was a $9 billion decision, a bet on the future of the North American electric vehicle industry, and for the United States, it felt like a public and profound rejection. The Japanese industrial titan, a keystone of the global auto market for decades, had not chosen a Sunbelt state in the American South or a revitalized site in the Midwest for its next-generation megafactory. It had chosen Canada. For the Biden administration, which had staked its industrial legacy on the Inflation Reduction Act and a manufacturing renaissance, the news landed like a diplomatic grenade. Senior officials had privately lobbied for months, offering incentives and extolling the virtues of American infrastructure. Yet the Japanese company, after a year-long global search, concluded its future lay north of the border. It was a stunning repudiation of the idea that the American market was the only logical destination for such a transformative investment, raising immediate questions about what the United States had failed to offer or what Canada had so cleverly provided. To understand the depth of this rupture, one must look back at the long and carefully cultivated economic relationship between Japan and the United States. For decades, Japanese automotive giants had built their North American empires on American soil, from Honda in Ohio to Toyota in Kentucky and Texas. This was a relationship built on mutual need. Japan gained access to the world's largest consumer market, and the United States gained hundreds of thousands of high-paying jobs. This transaction, valued at nearly $9 billion, was supposed to be the next chapter in that long and profitable history. Sources close to the Japanese conglomerate's boardroom, speaking on condition of anonymity due to the extreme sensitivity of the matter, paint a picture of a decision that was far from simple. The initial phase of the site selection process, we are told, was heavily tilted toward the United States. The company's advanced planning team spent months analyzing potential locations in Michigan, North Carolina, and Georgia, drawn by the promise of a skilled workforce and proximity to existing supply chains. The American offer on paper was substantial and competitive. Yet, as the due diligence deepened, a more complex and troubling picture began to emerge for the Japanese executives. The political climate in the United States, characterized by sharp partisan divisions and a looming presidential election, introduced a factor of instability that was difficult to quantify but impossible to ignore. Company officials grew increasingly concerned about the long-term durability of the very federal incentives that made the American sites so attractive. What if a new administration with a different energy policy took power in 2025 and sought to dismantle the current framework? It was this precise fear of political whiplash that became the Canadian delegation's most potent weapon. Canadian negotiators, led by a combination of federal ministers and provincial officials from Ontario, did not simply match the American offer, they structured it differently. They presented a unified bipartisan front with commitments locked in at both the federal and provincial levels, creating a legal and financial fortress that appeared far more resistant to the winds of political change than anything Washington could offer. The contrast in political culture was stark and, according to insiders, decisive. The Japanese board watched the spectacle of American debt-ceiling brinksmanship and government shutdown threats with growing alarm. In contrast, Canada, despite its own political differences, presented a picture of relative stability. The Canadian proposal was backed by all major parties, a signal of national consensus that resonated deeply with a corporate culture that prizes predictability and long-term planning above all else. But the decision transcended mere political calculus. Canadian officials also made a compelling argument about their country's rapidly evolving industrial ecosystem. They pointed not just to Ontario's historic role as the heart of Canadian auto manufacturing, but to a new concerted national strategy to build a complete end-to-end electric vehicle supply chain. This included access to Canada's vast reserves of critical minerals like lithium, nickel, and cobalt, essential for battery production, which the United States largely lacks. The $9 billion megafactory, therefore, is not an isolated project, but the crown jewel in a far larger national strategy. Analysts believe that Canada has successfully positioned itself not as a low-cost alternative, but as a vertically integrated hub. The deal includes upstream access to mines in the Canadian Shield and downstream integration with existing automotive assembly plants in Windsor and Brampton. It is a vision of a closed-loop system from raw earth to finished electric vehicle, something no single American state could realistically offer. This represents a profound shift in industrial logic. For years, the conventional wisdom held that raw materials were shipped to where the manufacturing expertise and capital resided. Canada has inverted that equation, convincing a major international player that the manufacturing and capital should come to the raw materials. It is a model that other resource-rich nations will undoubtedly study, and one that threatens to rewrite the rules of global trade in the green economy. For the United States, the sense of loss is compounded by the identity of the winner. It is not a rival superpower, but its closest neighbor and largest trading partner. The relationship between the U.S. and Canada is often described as the most successful partnership in the history of nations, but it has always been an asymmetrical one. This decision signals a new era of maturity and assertiveness from Ottawa, a willingness to compete aggressively and win against its southern giant. The political fallout in Washington has been immediate and intense. Republican critics have seized on the news as proof that the Biden administration's economic agenda is failing, arguing that the president's focus on green energy and labor unions has made the United States an unattractive partner for global capital. They claim that the Inflation Reduction Act, intended to lure investment, has instead created bureaucratic hurdles and uncertainty that drove this deal north. Behind closed doors, administration officials are engaged in a furious round of finger-pointing. The Commerce Department and the Office of the U.S. Trade Representative are said to be conducting a post-mortem, trying to pinpoint exactly where the American offer fell short. Some officials privately concede that the Canadian offer was simply superior, a comprehensive package that addressed corporate risk in a way the American patchwork of state and federal incentives could not. Yet others in Washington see a more nefarious subtext, suggesting the Japanese company played a sophisticated game, using the American offers to extract maximum concessions from the Canadians. This narrative, however, is dismissed by most independent trade experts, who argue that the deal's structure is too complex and the financial commitment too large for such a cynical bluff. The Japanese, they say, were genuinely torn, and Canada ultimately presented the safer, more coherent vision. The global implications of this decision are only now beginning to be understood. For other multinational corporations watching from Europe and Asia, the message is clear. The United States, for all its market size, carries significant political risk. The prospect of policy reversal after every election cycle is becoming a major deterrent for capital-intensive multi-decade projects. Nations that can offer a stable, predictable, and unified political environment now possess a powerful competitive advantage. The victory is a monumental one for Canadian Prime Minister Justin Trudeau, whose government has staked its environmental and economic legacy on becoming a green energy superpower. It validates his strategy of using aggressive subsidies and diplomatic charm offensives to attract global investment, even as his domestic popularity wanes. For Ontario Premier Doug Ford, it is a validation of his government's focus on eliminating red tape and creating a business-friendly climate in Canada's industrial heartland. For the workers in the American towns that lost the bid, the reality is a gut-wrenching blow. Communities in rural Georgia and industrial Michigan had been competing fiercely, offering land, tax breaks, and promises of a willing workforce. The prospect of thousands of jobs paying six-figure salaries, a generational opportunity, has vanished. The loss will be felt for years in school funding, local businesses, and the very morale of these communities. The Japanese company's CEO, in a rare and carefully scripted press conference in Tokyo, framed the decision in purely business terms. He spoke of access to clean energy, a stable regulatory environment, and a shared vision for a sustainable future. He pointedly avoided any criticism of the United States, thanking American officials for their hospitality and interest. But the subtext was unmistakable. Business certainty had trumped market size. Industry analysts are now revising their forecasts for the North American EV market. The concentration of battery production in Canada, combined with the U.S. Inflation Reduction Act's production tax credits, will create a unique and potentially volatile dynamic. Automakers on both sides of the border will now be competing for a limited pool of batteries, with Canadian assembled packs potentially holding a cost advantage due to their integration with domestically sourced minerals. The concept of friendshoring, the practice of moving supply chains to politically reliable allies, has been a central tenet of Western economic policy since the pandemic. On the surface, a Japanese company choosing Canada is a perfect example of this principle in action. However, the fact that it did so at the expense of the United States exposes the inherent contradictions and fierce competition that exists even among the closest of allies. This is a story about the new rules of globalization. It is no longer enough to be a large market. You must be a predictable one. It is no longer enough to offer tax breaks. You must offer a holistic vision that encompasses energy, resources, and political stability. The $9 billion decision is a case study in how nations will compete for the defining industries of the 21st century, and the early winner is not the one with the biggest wallet, but the most credible long-term plan. Looking ahead, the consequences for the United States could be profound and enduring. If this becomes a pattern, if other global giants begin to view the U.S. as a high-risk investment environment, the ambitious goals of the Inflation Reduction Act could fall woefully short. The act was designed to be a magnet, but if its core incentives are perceived as politically fragile, it may repel the very investment it was designed to attract. The Japanese decision has already sparked a quiet panic in other American ally capitals. Officials in Seoul, Berlin, and London are watching closely, and early indications suggest they are recalibrating their own trade strategies. The lesson they are drawing is that the United States cannot be relied upon as a stable partner for the long haul, and that building direct relationships with other G7 nations might offer a more secure path to industrial development. For Canada, the challenge now is execution. The company will expect the seamless integration of policy, energy, and labor that was promised. Any significant delays or regulatory hiccups will be magnified and could deter the next wave of investment. Ottawa must now deliver on its ambitious promises, transforming its political victory into an operational reality, knowing the entire world is watching. The risk of a subsidy war with the United States is now very real. Washington could respond by dramatically increasing its own offers to the next company looking to build a megafactory, creating a race to the bottom that benefits no one. This could fracture the carefully constructed trade relationship under the USMCA agreement and lead to a cascade of retaliatory measures that harm the entire North American economy. There is also the geopolitical dimension to consider. The United States and its allies are engaged in a high-stakes competition with China for dominance in the electric vehicle sector, a divided North American market with the US and Canada now effectively competing against each other for investment plays directly into Beijing's hands. It fragments the Western Bloc and dilutes the collective industrial power needed to counter China's state-driven manufacturing machine. The Japanese company's board, we understand, considered this geopolitical angle as well. Some members argued that choosing Canada was actually a way of strengthening the North American bloc as a whole by building resilience into the northern part of the supply chain. In their view, a diversified North American production base with strengths in both countries is ultimately more robust than one concentrated solely in the United States. For the average consumer in Des Moines or Dallas, this complex geopolitical and industrial drama will eventually manifest in a simple way: the price of their next car. If Canadian batteries prove cheaper and more plentiful, American automakers may be forced to import more components from the north, potentially increasing costs for vehicles assembled in the U.S. The $9 billion decision could, paradoxically, make American cars less competitive in the long run. The narrative of American decline, so often overstated, finds a concrete example in this story. It is not a story of rust and decay, but of a slow erosion of trust and predictability. It suggests that the United States' greatest economic asset, its political stability, is no longer seen as a given by international investors. The constant threat of policy reversal, of a government shutdown, of debt default, carries a real and measurable cost. The final irony is that the Japanese company may have found a safer harbor in a country that is, in many ways, a reflection of America's own past. Canada today offers what the United States offered global capital in the post-war era: a confident, stable, and predictable partner with a clear vision for the future. It is a role the United States took for granted, and one it is now watching its neighbor assume. As the first bulldozers prepare to break ground on the Ontario site, the full weight of this moment is settling on the policymakers in Washington. The loss is not just economic, it is psychological. It is a blow to the idea of American exceptionalism, a reminder that the world's preferred destination for investment has options, and that in a world hungry for certainty, the old order is no longer guaranteed. The shockwave from this single corporate decision will ripple through the global economy for a decade. It has redrawn the map of the electric vehicle industry, redefined the relationship between two of the world's oldest allies, and issued a stark warning to any nation that believes its size alone guarantees its future. The race for the industries of tomorrow has just begun, and the first major battle has been won, not by a superpower, but by the promise of stability.